Now let's learn the concept, Nana, accounting for derivatives. Once we are done with this, we'll go for embedded derivatives. And I think after that, mostly we are done with this particular chapter. Only hedging will be left over. Okay. Yeah. That's it. With that, we are done with this, all the concepts of this particular chapter. Okay. Right. Now, accounting for derivatives. Now, I think we have already done with so many sessions. I think you guys remember the concept of derivatives, correct? So derivatives is like in itself, it does not have any value. It derives the value from an underlying asset. Okay, from something else. There will be something underlying, from that it derives the value. Okay, just keep it in mind. Under derivatives, we have seen forward contracts. We have seen future contracts. We have seen options as well. Call option, put option, call option buying, call option selling, put option buying, put option selling. So all these basic concepts already we have seen in a detailed way with examples, correct? So now from there, we're going to continue. Now, let me tell you one thing before we continue further with this particular session. If you remember what is forward contracts, what is future contracts, what is a call option, what is a put option, who is call option buyer, who is call option seller or writer, put option buyer, put option seller, or put option holder, or put option writer. So there are so many names, right? All these things, if you remember, let's continue with this particular session. If you don't remember, then stop the session here. Live students, they can't do anything, but people who are going to watch the video session in future, you stop the session right here, go back and try to revise it and then come back. Then only this session will be fruitful. Otherwise, this session will not make any sense for you. So therefore, you stop it right here, go back and revise all those concepts which we have already discussed, which you should be remembering properly. Okay, then only let's continue with this session. Otherwise, stop here, go back, revise, and then come. Clear? I hope this is clear, guys. All right. Now let's continue with the session. First of all, one thing what you guys need to understand is that when it comes to derivatives, we will always do accounting for derivatives at FETPL. Straightforward, simple sentence. All derivative contracts have to be measured using FETPL. Okay, right? What is the reason behind FETPL? Why we always account derivatives using FETPL is because derivatives will have a lot of fluctuations, high fluctuations. They are very sensitive to market changes. You understand the point? As a result, when market even changes by a slight bit, derivative will show reaction. That is why it is only prudent and logical for us to take all those changes into P&L account. That's why we always measure derivatives at FETPL. So FETPL indirectly talks about your exit value. So fair value means what are we talking about? Say for example, I have a derivative right now. If I sell it in the market as of today, okay, presuming that I have a buy position, if I have a sell position, if I buy it in the market, that's how you set it off, right? You already bought, then you think about selling. You have already sold, then you think about buying. Okay. So what do you mean by already sold and you think about buying? Means short selling concept, which we have already discussed. Okay. Right. Anyways, now the point that you guys need to understand here is that, so when I talk about fair value, I'm talking about the exit value. Exit value in the sense, if you try to come out of that particular contract taking an opposite position to what you have already taken, okay, is nothing but fair value. So that's why we try to apply FETPL when it comes to accounting of derivatives. This is also another way of looking at it. So I'm just trying to get the logic behind. Okay. So anyways, you'll try to get a much much deeper idea once we go further. Right now, this is the basic idea. Okay. But there is an exceptional situation. If you are applying these derivatives, if you are entering into a derivative contract purely for the purpose of hedging, only in that case, the changes in the fair value will go to OCA. Got the point? Otherwise, the changes in fair value will go to P&L account. Got it? This is one of the exception. One more exception is there when it comes to equity instruments that we will see later. Right now, we are just talking about in general. In general, what is the concept of derivative? Okay, right. Another important words that you have to understand is long position means you are basically buying. Short position means you are trying to sell. Okay. In other words, to be very precise, long position means agree to buy. Short position means agree to sell. Keep this in mind. This is very important because frequently we'll be using the word long position. We'll be using the word short position. Long position means you have agreed to buy in future. Short position means you have agreed to sell in future. Clear? Right. So this is the basics. Now let's start with the first example. I've written everything in detailed way in this power notes when with respect to this particular example. By the time we finish off this example, almost you should be getting clear cut clarity with respect to derivative accounting. Okay. Okay, so what did we learn so far? When it comes to derivative accounting, always we'll be using FETPL, although there is an exception. If you are doing, if you are entering into derivative contract for the purpose of hedging, then you will take the fair value changes to OCI, which means there you will not be doing FTPL accounting, because in FETPL accounting, whatever the changes in fair value, you'll be taking it to P&L account and not OCI. Clear? Right. And two more things we need to learn is long position, which means you have agreed to buy. Short position means you have agreed to sell. Right. Let's start with example 1. Today's spot rate $1 is equal to 62 rupees as on 1st January 2018. X Limited has entered into a forward contract to buy. Contract to buy means he is in long position, which means he has agreed to buy. What did he agree to buy? $10,000, that is the currency dollars, at $1 is equal to 60 rupees. On which date? 30th June 2018. Where are we right now? 1st Jan 2018, which means roughly 6 months from today. He has entered into a forward contract where in future he has agreed to buy each dollar at 60 rupees. Like that, he has agreed to buy how much quantity of dollars? $10,000. Okay, in essence, after 6 months, right? Spot rate on 31st March 2018, that is on the reporting date, is $1 is equal to 60 rupees, right? Then on 31st March 2018, 3 months forward rate, $1 is equal to 63.5. Okay. On 30th June 2018, spot rate is 65. $1 is equal to, which means fast forward into future, after 6 months, your spot rate is $1 is equal to 65. Show the accounting for forward contract in the books of X Limited. First of all, in this example, we are talking about forward contract. Let it be very clear, right? Okay. Is forward contract a derivative? Of course it is. Okay. So what is the kind of position that you have entered into? Long position. Long position means what? You have agreed to buy. Okay. Chalo. Now let's try to clearly understand how do we do the accounting. So I want you guys to focus 100%. Shall we start? Okay, Nana. Now let's start from today. Okay. Today is 1st January 2018. Today, what is the spot rate, Nana? As of today, $1 is equal to 62 rupees. So you have entered into a long position where you have agreed to sell after 6 months. Sorry, where you have agreed to buy after 6 months a dollar at 60. Generally, tell me one thing, when anybody will enter into a long position where you have agreed to buy after 6 months at a particular rate, because you are of the expectation that definitely the dollar value will increase. The dollar will appreciate, where you will be in a forward contract where you already have a position which is locked, where you'll be buying a dollar at 60, whereas you are of the opinion that you are of the expectation that definitely the dollar will be available at a much higher price in the real market on that particular date, that is after 6 months. So that you have locked the price today at 60. You are expecting that it will be available at 62, 63, 64, 65 or something like that. So that because you have locked, definitely the other party has to, you know, accept this particular price. He's obligated to do that, which means eventually you'll be able to buy it at 60 and you'll be able to sell it in the market at 62, 63, 64, 65 or 68, whatever it is, that price on that particular day after 6 months, and eventually you'll be able to make a profit out of it. That's the whole game over here. So you're betting that dollar will appreciate and rupee will depreciate. That is the logic. That's why you have entered into a long position, which means you have agreed to buy in future after 6 months at 60 rupees. Got it? Chalo. So on 1/1/2018, I've entered into a forward contract where X Limited, I means X Limited over here, okay, went long, which means agreed to buy currency. How many units of currency? 1000 units of currency. What currency? Dollars at $1 is equal to 60 rupees. At 60 rupees, you have agreed to buy a dollar. 10,000, $1,000 after 6 months. As of today, what is the fair value of the forward contract? As of today, the value is 0. One way of looking at it is, did you spend any money today to enter into this particular contract? No. In case of options, if you're buying the options, you'll pay premium, right? But here, did you do anything? No. So therefore, there is no entry. You got the point. This is one way of looking at it. The other way of looking at it is, because if you sell this today, suppose you sell this forward contract today, the other guy also will buy from you at $60 only, right? At 60 rupees, $1 only, correct? Which means even if you sell this today, you will sell it at the same price. What price? $1 is equal to 60 rupees, whatever the price that you have entered into. You understand the point? Therefore, your sell rate and buy rate will be same. Therefore, ultimately, you will not be getting any profit, which means basically you will recognize it at 0. In that case, don't recognize it. What do you mean by recognizing it at zero? Got the point? So therefore, no investment in case of forward or futures, but not in the case of options, because in the case of options, especially you're doing option buying, you have to invest because you have to pay premium. In case of option selling, you'll be receiving premium. So either way, you cannot say there will be no entry. So what you need to understand here is that in case of forward contracts, there will be no entry at the beginning. Same in case of futures as well. In both these cases, zero entry during the initial recognition date. Clear? Now, moving on. Now, in between your 1/1/2018 and the 6 months date, which is 30th June 2018, we have a reporting date. You got the point, right? On the reporting date as well, you have to do accounting. Why? Because we are going to apply which method? FETPL. Therefore, on the reporting date, you need to measure it at fair value. What is the value of your so-called forward contract on this particular date? Right. On this particular date, you need to look at, now see here, you should not be looking at the spot rate on 31st March 2018, because spot rate does not make any sense. On that day, what is the rate? You got the point. You are into a forward contract. So suppose you are on 31st March 2018, and if you would have entered a forward contract on this particular date, which means from this date, how much is the forward contract date for you? 3 months now. You understand the point? If at all you would have entered from this particular date, it would have taken 3 months for you, because your ultimate date is 30th June. On 1st January, it is 6 months, right? 6 months from today. But on 31st March, it will be 3 months from today. So therefore, compare your contract with a 3 months forward contract from today, because your contract also has surpassed 3 months now. Right now, even your forward contract will have an expiry date of 3 months from today, correct? Therefore, you should be comparing that with another contract which will have 3 months expiry date from today, correct? Because your forward contract also is having 3 months expiry date from today, because today is 31st March, not 1st Jan. From 1st Jan, your expiry date is 6 months, whereas from 31st March, your expiry date is only 3 months. So you compare that with another forward contract which is having 3 months expiry date. So if you look at the 3 months forward rate, it is available at $63.501. So which means if you take an opposite position and if you try to exit the forward contract today, you can sell your forward contract for $63.51, whereas you have purchased it at $61. You understand the point? So 60 rupees $1 is what you have entered into, whereas today if you sell it, you'll be getting for each dollar 63.5. So if you want to exit out today, at what price is the fair value? Because you have to do fair value accounting, which is FATPL, correct? So assume notional cancellation, although you're not cancelling. Assume that if you cancel, then what will happen? You will take an opposite contract where as a company, you will try to sell $10,000 at a 3 months forward contract. Again, what is the rate? 63.50 for 3 months forward contract. You should not be getting confused with spot rate. You need to compare with an equivalent contract. What is your contract? Your contract has got an expiry of 3 months. So you compare that with another contract which has equivalent expiry of 3 months, which is nothing but 3 months forward contract on 31st March. You understand the point? If you look that, then your sell rate is 63.5. What was your buy rate? 60. Therefore, the difference of 3.50 is your gain on $1. How many dollars you have agreed? $10,000. So $10,000 into 3.5 will give you a gain of 35,000. Gain of 35,000 means your derivative asset value has got increased. It's a financial asset only. Whenever you get a gain in derivative, it will be a financial asset. Whenever you get a loss in a derivative, it will be a financial liability. So derivative can be financial asset, derivative can be financial liability, derivative can be equity instrument. You understand the point? Are we getting gain right now in this derivative? Yes. In that case, it's a financial asset. Within brackets, you'll write derivative. You will debit because it's an asset. Obviously, it has to be debited by how much? 35,000. And this much gain, because you are following FETPL accounting, has to be transferred to P&L account. Therefore, it will be transferred to P&L account. Done. Clear? All right. Now, let's move on to the last date, the day, which is 30th June 2018. On this day, you have a spot rate where $1 is available at 65. Spot rate, spot rate, spot rate. Clear? Now, tell me one thing. This day you are going to close your contract. Obviously, you have reached, automatically your contract gets closed, obviously, because you have reached the expiry date, correct? So gain in forward contract is how much? Total gain, total gain. 65 rupees today you can sell $1. Whereas you have agreed to buy, you have taken a long position, na? What is that long position? After 6 months, I will be buying each dollar at 60 rupees. That is what the position that you have taken. So which means today, You will be able to buy dollar according to this contract at 60 rupees. How many dollars you will be able to buy? $10,000. And you will be able to sell in the market at spot rate at 65. Got the point? Therefore, you have a gain of 5 rupees, which is nothing but total gain of 50,000, right? 5 rupees per dollar into $10,000. So total 50,000. Now the question is, already I have recognized a gain of 35,000, correct? On my reporting date, correct? Because I have to measure it at fair value. And that gain has been transferred to P&L account as well. So out of this total gain of 50,000, how much I have already realized? 35,000. And to the extent of 35,000, I have increased the financial asset. I have recognized the financial asset derivative, and that has been taken to P&L account as well. So today, how much I should be recognizing? The balance. How much is the balance? 15,000. To that extent of 15,000, again you recognize. So therefore, financial asset debit, derivative, 15,000, the balance, that will be taken to P&L account. So to P&L account, 15,000. Got it? Right. Now, because it is the day, the expiry date of your forward contract, settlement will happen. There are two possibilities of settlement: cash settlement, net cash settlement, physical delivery settlement as well. Mostly 99% of the cases, of course, because this is a forward contract, there is a chance of physical delivery as well, physical delivery settlement, but mostly net cash settlement only will happen. If it is a net cash settlement, what will happen? You'll be getting your money. How much money you are getting? Equivalent to your gain. How much is your gain? 50,000. So therefore, you'll be getting 50,000. Once you get money, what you will do? Bank account debit. That's all. What you will credit? Because of which did I get this particular 50,000? Because of financial asset derivative. How much is that financial derivative showing in your books? On 31st March, you have booked 35,000. Today, you have booked 15,000. Total, your financial asset derivative will be showing 50,000 book value. Cancel it off. Because it's an asset. Now that you have recognized the asset, now that you have realized the asset, so therefore you have got 50,000. Therefore, the asset value is no more 50,000. It is zero now. As long as you did not realize 50,000, the asset value, derivative asset value is 50,000. Today you have realized 50,000 because you have received the money in your bank account. Therefore, the asset no more is valuable at 50,000. The asset value is zero because you have realized. It's as if you have sold the asset. You understand the point? Therefore, the asset has to be de-recognized. So credited, the asset is gone. Earlier it was having a debit balance of 50. Now you have created. So total balance is 0 and you have received 50,000 to your bank account. So if you go for net cash settlement, it's very easy actually. However, in rare case scenario, suppose if you go for physical delivery, then forward contract will be closed by way of physical delivery. If that is the situation, then what happens? What happens means physically you need to buy $10,000. If you need to buy $10,000, what is the agreement? I will buy $10,000 at 60 rupees per dollar. So 60 rupees per dollar into $10,000, how much is the total? 6 lakhs, obviously. So 6 lakhs you have to pay to buy, because that was the agreement. Now, long position. Long position means agree to buy. Agree to buy what? Each dollar at 60 rupees. Like that, how many dollars? $10,000. Therefore, 60 rupees into $10,000 will be 6 lakhs. So there will be a bank payment of 6 lakhs. Therefore, to bank 6 lakhs. Got the point? However, how much worth dollars will I receive? By paying this much, by paying 6 lakhs, I'm receiving $10,000, correct? I've agreed to buy at a price of 60 rupees, but today, that particular asset, the asset is nothing but currency. What currency? Foreign currency. What is that foreign currency? Dollars. That asset value is how much in the market today? 65 rupees. So you should be recognizing asset at your fair value or market value only now. So what is your market value? 65 rupees for $10,000. Therefore, you should be debiting your asset at the fair value or market value, which is 65 lakhs. Whereas you have paid only 60 lakhs. What is the difference of 5 lakhs? Gain for you. Sorry. 6,50,000. Okay. 6,50,000. You have paid 6 lakhs. Okay. There is a gain of 50,000. Okay. Sorry for that. Okay. You have a gain of 50,000. Therefore, to P&L account, a gain of 50,000. I think wrongly I have told 65 lakhs. It's okay. Forgive me. Okay. So therefore, finally, I have actually paid 6 lakhs. And I've got $10,000 currency. That $10,000 currency is nothing but asset for me. Today, the worth of this $10,000 asset is 6,50,000. So therefore, I'll recognize this $10,000 asset at 6,50,000. However, I've paid only 6 lakhs. Therefore, that 50,000 will be a gain for me, right? You understand the point? That gain, usually, I'll be writing like this to P&L account. But however, we are doing FETPL accounting. So already I've recognized that gain, 35,000 on the balance sheet date and another 50,000 today. Already that 50,000 has been taken to P&L account by creating a derivative asset worth of 50,000. Now that you have done the physical delivery, that derivative asset no more exists because it is closed right now. Therefore, you credited 50,000, gone. That's how you'll pass the entry. Finished, huh? Are we done with this example? Okay, right. Let's go to another example. Suppose X Limited writes a call option. Now we are getting into options. This example purely was based on what? Forward contract. Now we are getting into options. Ready? Okay. X Limited writes a call option, which means you have sold the call option, your option seller, on its own equity shares. Okay, now we are talking about equity shares. Right. What do you mean by writing a call option on your own equity shares? First of all, writing a call option means what? Call option means it is an option to buy, right? If you are a call option buyer means you have a right to buy, correct? If you are a call option seller means you have an obligation to sell. Got the point? So X Limited writes a call option means it has got obligation to sell. Sell what? Its own equity shares. How many? 1,000 numbers. To whom? Y Limited. At what price? 60 rupees per share. Exercise price is 60 rupees per share, which means X Limited has entered into a options contract where it has written its own call option on its own equity shares, which means it has got an obligation to sell its own equity shares after 3 months at a price of 60 in case if Y Limited exercises the options, because in this case Y Limited is the call option buyer. So Y Limited will have a right to buy after 3 months. I will have obligation to sell. If Y Limited feels that it will be profitable, then he will exercise the option. Then he will exercise his right to buy. Then we have to exercise our own obligation to sell. I need to sell at 60 rupees. You understand the point? This is the agreement. Right. Now, is this a derivative? Yes, it's a call option. Right. But it is regarding equity instrument. Correct? Because we are talking about equity shares. Correct? Therefore, in this kind of situation, you should not go for FATPL accounting. Premium, whatever that you have received, because you have sold the option, you would have received premium from the option buyer, that is Y Limited. Your option seller, that is X Limited. So whatever the premium that you receive will be adjusted against retained earnings, which means what you need to understand is when it comes to derivatives, derivatives can be an equity instrument, derivatives can be a financial asset, derivatives can be a financial liability, derivatives can be a non-financial asset as well, gold, something like that. On that also you can have a derivative contract. Understand the point? If derivatives is with respect to non-financial asset, then it is out of the scope of 109. Forget about it. If derivatives can be a financial liability, you will account it as per FATPL, which we have already learned. If derivatives can be a financial asset, then also FATPL. However, if derivatives can be an equity instrument, then it should be adjusted against retained earnings. Clear? This is another exception. Earlier, what is the other exception that we have seen? Derivative contract which you have entered in case of hedge accounting, in that case the change in fair value will be transferred to OCI and not P&L account. That is one exception. The another exception that we have seen here, where derivative contracts that you enter in case of an equity instrument will be adjusted against retained earnings. Clear? Everybody? Alright, Anna, shall we move on with this example? Example 2. Why option premium on your equity goes straight to retained earnings? Okay. See, first of all, it is not income. Now, everybody else also here, one student have asked me doubt. Listen carefully. Okay, it's a good doubt. Anyway, now listen. See, Nana, when you sell an option on your own shares, here your own equity instrument, if you look at this example, X Limited writes a call option on its own equity shares. So, which means basically X Limited writes a call option means it has got an obligation to sell its own equity shares. Basically, you're selling an option on your own equity shares, right? So, you're not basically entering into a trading contract. If you only trade or if you do speculation, then only we go for FATPL accounting, if you remember. Correct. So here it is not like a trading contract. You are just issuing another equity instrument of yours. So this is like receiving money for issuing more shares. So it is treated as equity, not as income. So there is no real liability for you. A written option on your own equity share doesn't obligate you to pay cash, na? It only obligates you to deliver shares. The other guy will buy the shares. Here also Y Limited will pay you money. So your obligation is only to deliver shares. Obligation of delivering shares is not a liability. Obligation to deliver cash or something else or another financial asset is a liability. Obligation to deliver your own shares is not a liability. It's equity. You understand the point? So just like receiving capital contribution, so you will be recording that by increasing your retained earnings, not P&L account. You understand the point? This ensures that your earnings is not overstated by what's actually an equity event. There will be no fair value fluctuations as well because you are not routing through P&L. Na? See, I'll try to simplify this. Listen carefully, everybody. I'll just simplify this in one sentence. Very simplified version. You sell a share as a company X Limited right now in this example. I sell a share, cash increases equity, correct? You sell a share, you receive cash, and you increase your equity share capital, correct? That's what happens when you sell a share. Sell a share means issuing share, na? Okay, your own company share. Here, what you're doing, you're selling an option on your share, and you receive cash from Y Limited, correct? Here also, your cash should increase your equity. What equity? Retained earnings, it will increase, and not P&L. Clear? Again, I repeat, you sell a share, cash increases your equity. You sell an option on your share, which you have done here. You get cash, which should increase your equity. That is retained earnings. Retained earnings is part of your equity, right? And not P&L. Clear? Fantastic. Right. Now let's go to this example. Example 2. You guys are ready? Now, Z Limited has taken up a long position, which means agreed to buy in 3 months ITC futures. Futures are nothing but forward contracts. Both are same, except that futures will happen with respect to stock market, right? And on an exchange platform, right? At rupees 265. Okay. 3 months ITC futures at rupees 265. So which means agree to buy after 3 months at 265. Okay. When did you enter onto this contract? On 1st February 2018. Okay. On 31st March, obviously in between the reporting date has come. The spot price of the ITC share is 270. And from that reporting date, that is 31st March, 1 month future price is 275. That is important for us. Okay. On 30th April, that is the day, the expiry day, the settlement date, market price of the ITC share is, case 1, if the market price is 275, what will happen? Which means we are talking about the spot price. If the spot price is 260, then what will happen? That is the situation. Okay, so this is again a futures contract and it is a derivative. Obviously, we have to do accounting. Now tell me, in case of forwards as well as futures contract, what did I say? There will be no initial recognition. It will be 0. There will be no entry. Therefore, no entry. The first entry will happen on 31st March 2018. Why? Because you have to do FETPL accounting. FETPL account means on reporting date, you need to measure it at fair value. And if there is any changes in the fair value, that will be taken to P&L account. Clear? Right. Now let's come to 31st March 2018. So what is happening here? To calculate the fair value, we need to assume notional cancellation. In reality, we will not cancel, but for the accounting purpose, we'll presume as if we are selling. So if you sell, what's going to happen? Obviously, your position is to buy at 265. What is the price on 31st March 2018? Should I be taking spot price? No, you should not be touching the spot price because as on 31st March 2018, you still have an expiry of 1 month. So you should be comparing this because yours is a futures contract with an expiry of 1 month only. Na? So you should be comparing that with another futures contract which has got a similar expiry of 1 month. Got it? So you have 1 month futures price at what? 275. Okay. You have agreed to buy at 265. Today, if you sell, you'll be getting 275. So there is a gain of 10 rupees. So when there is a gain, it's a financial asset. The derivative becomes financial asset. So you debit to the extent of 10 rupees and that will be transferred to P&L account because you are following FETPL. So it is transferred to P&L account. Clear? Right. Now next come to the settlement date. On settlement date, there are two choices. Your spot price can be 278. Your spot price can be 260. First, let's start with 278. If your spot price is 278, you have agreed to buy at 265. That is your original contract, correct? So therefore, between 265 and 278, your total gain is 13 rupees. However, out of this 13 rupees, already 10 rupees gain has been recognized. So how much further I need to recognize 3 rupees? To that extent, if it is a gain, it's a financial asset derivative. 3 rupees that will be transferred to P&L account. So financial asset derivative debit to P&L account 3. Clear? Right. Now again, if there is a physical delivery, if there is a cash settlement, two things will happen. If there is cash settlement, what will happen? You will be getting 13 rupees. The total gain money you will receive. And because the asset value is realized, you will be cancelling the asset and removing it from your balance sheet, obviously. So you will write to financial asset derivative 13. That's it, gone. If there is a physical delivery, then what will happen? You will be in reality purchasing an ITC share by paying how much? 265, because that was your agreement. I will buy an ITC share at 265, correct? So you will be paying 265, whereas you will be getting an ITC share worth 275. So there is a gain of 10 rupees, but then that gain has already been recognized. It has been taken to P&L account by creating a derivative financial asset. Got it? Now that physical delivery has happened, that financial asset should no more exist. Got it? Therefore, it has to be cancelled out. So therefore, 2 financial asset derivative 13. Done. Finished? Right. Now suppose if your market price is 260, then what happens? Right, you have agreed to buy at 265, whereas now you can sell it in the market at 260 only. So there is a loss of 5. However, already I have recognized a gain of 10. That gain of 10 should be cancelled out, correct? So how will you cancel out? Pass a reverse entry. Earlier you have debited the financial asset. There was a derivative asset and you have created P&L account. Now you debit P&L account and credit the asset. Therefore asset becomes 0. That financial asset derivative no more exists. Now you have a loss of 5 rupees that has to be booked now. Therefore P&L account should be debited because there is a loss. It's a financial liability derivative. Therefore financial liability derivative you will create to the extent of loss. Clear? Now if there is a physical delivery, what you will do? Obviously you will be, tell me one thing, you'll be buying your share by paying how much? 265. However, that share worth is how much? 260 only. So you'll be debiting your asset at its worth only, which is 260. That is market price. There is a difference of 5 rupees. For that loss, you have already debited the P&L account by creating a liability of 5 rupees. Now that you have already paid 265 and you have purchased that asset, that liability does not exist. Therefore, you need to cancel that financial liability derivative. Thereby, you debit it and cancel it up. See, financial liability derivative means it will be showing credit balance. So you debit it and you cancel it out. In case of physical delivery, that's it, gone. Got it? Are we done with this example as well? Example 2, right. Now let's move on to another example. Now in example 2, we have gone through futures. In example 1, we have gone through forward contract. So forward derivative is done. Futures derivative is also done. Now let's go to options. Okay. We'll just have a basic idea of options and then we'll go for the accounting part of the options as well. Got it? Right. Now let's go with the options example. We are already done with forward example. We are done with futures example. Now let's go to the options. We'll be covering all sorts of derivatives. Okay. Right. Now, Nana, coming on to the third example. So in third example, obviously we're going to look into what, Nana? Options. Now listen carefully. Let's say current date is 1st January 25. Okay. Call option. You are buying call option. So when you buy a call option, you are called call option buyer or holder as well. Holder means nothing but who has bought the option. Okay. So when you buy a call option, what's the logic over here? You have purchased right to buy at an exercise price. Okay. So what is that exercise price? 250 and the maturity is 3 months and the premium is 10 rupees, which means basically what's happening is that you pay 10 rupees to buy a right to buy. Okay. You bought a right to buy because right does not come free. You paid 10 rupees to buy right to buy at an exercise price of 250 rupees, right? Which means after 3 months, I can buy a particular share at 250. I have right to buy at 250. So if I want, I'll buy. If I don't want, I'll not buy. You got the point? So there is no obligation. And the underlying asset is share of PK Limited. U by A means underlying asset. The underlying asset is share of PK Limited. Okay. Now, when you are a call option buyer where you have a right to buy, it means that you are set to be in a long position because you have got right to buy. Na? So either you will buy or you will not buy. So which means you have taken a long position. So which means you are expecting the share price of PK Limited to increase in future. You understand the point? So if you expect the share price of PK Limited to increase in future, you will buy a call option. So as per call option, you have fixed a price to buy. So tomorrow when the actual price in the spot market increases more than 250, you have a right to buy at 250. You will exercise the option. You will buy the share price of PK Limited at 250 and then you sell it in the real market at 260, 270, 280. So basically you are bullish if you're a call option buyer. Clear? Now let's come to 1st February 25. This is a 3-month option. So we have come 1 month later. Okay. On 1st February 25, the premium went all the way to 18 for the same option. Okay. The premium went all the way to 18 because 1 month is gone. Hereafter, you'll be getting balance 2 months only because 1 month has expired. Still 2 months is left over for your call option to completely expire. Okay. So 1 month is gone. Still 2 months is left over. You have a premium of 18. So what you can do if you want to exit this particular position, you have to take the opposite position. What is your position right now? Buyer. So if you have to take an opposite position, then you have to become seller. So you sell the call option, you'll go short, and still there is 2 months left, and you'll be selling it at 18 of the same option. In that case, what will happen eventually, you'll be able to come out of this particular option and you'll be having a profit of 8 rupees because you have bought the option at 10, you have sold the option at 18. Clear? So what did I write here? Now that you are both holder and writer, which means buyer and seller, which means you have taken both the positions. So obviously they will cancel out. So once they will cancel out, you're out of the market and you booked a profit of 8 rupees because you have bought it at 10. You paid 10 and you bought the option. Now you have sold it at 18. So somebody has paid you 18 rupees. Got it? So therefore there's a profit of 8 rupees. So this is basically how option buying works. I just gave you a basic idea with numbers. So what you need to understand from this example is that there is no need for you to wait all the way till expiry date to exit the option. At any given point of time, you can exit by taking the opposite position. That's what I'm trying to communicate right now. Is this clear? Shall we move on? Right. Now let's focus on the accounting part now by taking a proper example. Okay. Still we are into options only. We did not see the accounting part. For futures as well as for forward contract, we are done with the accounting part as well. We have seen the entries as well, right? But when it comes to options, we did not see the accounting part. All we have seen so far is only understanding what is happening. Clear? Let's get to the accounting part now. You guys are ready? All right, guys. Let's continue with the session. So I just gave you an idea over how the options will work, right? Now let's focus on the accounting part per se, right? Now, chalo see here. A Limited has purchased a call option from B Limited, okay, at a premium of 12%. So when you buy a call option, obviously you have to pay premium, or you buy any option for that matter, you have to pay premium. The option seller will receive the premium. The share having an exercise price of rupees 90. So exercise price is the price at which you will buy in future, okay, in a call option, obviously. The above transaction took place on 1st February 2018 and the exercise date is 30th April 2018. So which means typically 3 months. Okay. On 31st March, that is on the reporting date or the balance sheet date, as usual, fair value of the call option is 19, which means obviously the call option has got increased, right? On 30th April, that is the date, the settlement date, market price of the share is 125. So you have an exercise price of how much? 90. Show the accounting in the books of A Limited and B Limited. Okay. So A Limited has purchased the call option. So he's a call option buyer. From his books, you have to show the accounting, as well as B Limited is the call option seller. From his books also, you have to show accounting. So that's good. Okay. Now, you guys have done with the reading of the question, right? Straight away, shall I move on? Now, let's look at the accounting in the books of the holder. Okay. Holder is nothing but option buyer, Nana. You can call him as a buyer or you can also call him as a holder of the option. Okay. Chalo. Now, accounting in the books of A Limited, because A Limited is the holder in this case. So actually, what did he do? He bought a call option by paying a premium of 12 rupees such that he has got right to buy after 3 months at a price of 90. Okay. Right now, so what is the transaction day on which he has purchased the call option? That is 1st February 2018. 1st February 2018, please try to understand, that is nothing but the day one. The day one, when it comes to forward and futures contract, we will not be passing any entry because there is no cash outflow or cash inflow, right? But that's not the case when it comes to your options, whether you're buying an option or you're selling an option. In both the cases, either you pay money or you receive money. So to recognize that, obviously got to pass an entry. Am I clear? Now in this case, we are doing this in the books of the option buyer. So obviously he'll be paying money and he'll be buying the option. So naturally to bank, if you pay money, and by paying money, what is actually getting created over here? Now you people have to tell me. By paying money, what is actually getting created over here? Now this so-called premium will be recognized as a financial asset. Within brackets, I've written D here. Obviously, it represents what, Nana? Derivative. Right. Now, many students have got doubt. They've asked me so many times that why are you recognizing this premium as an asset, the premium that you have paid? Isn't it? Already I'm getting doubts over here. Right. See, on the date the option is purchased, which is 1st February 2018, the buyer acquires a legal right. So you can call it as a contractual right or real right. Now, point here is, A call option gives the right to buy the underlying asset at a fixed price, right? You can buy the so-called share, whatever the share that you purchased, at a fixed price, which is 90, correct? So this right, the right to buy at a particular price has got a market value. You can separate it and you can sell it. Only this right. It is separable and tradable, correct? It could even be sold to someone else, correct? Everybody. Therefore, it meets the definition of the asset. Now, what is the definition of the asset? You people tell me. A resource controlled by an entity, correct? You need to control that resource from which future economic benefits are expected. We call that as an asset. So, is this right? Is a kind of a resource that is controlled by the entity over here, which is A limited? And are you expecting future economic benefits out of this? Yes. See, from this period onwards, from this day onwards, only if you get benefit, you'll exercise this option. If you don't get benefit, you'll not exercise this option. You understand the point? So you have a right. You don't have an obligation. Obligation is a liability. A right is an asset. Obligation is a liability. Right is an asset. Look at the financial asset definition as well, Nana. A right to receive something. You understand the point? A right to receive something. Correct? Obligation to pay something is liability. I hope that is clear, everybody. Yeah, some of the students have asked me this doubt that, sir, no, sir, in future, there might be a scenario where you are, say, for example, in this case, the price is 125. Suppose if the price is 85, you have a right to buy at 90 in this option, whereas from the external market, in future, after 3 months, you can buy it at 85 itself. In that case, would you exercise the option? You will not exercise the option. In that case, option gets excited. I mean, option gets expired, right? Lapsed, whatever you can call. Okay, whichever name you want to call. But the thing is, in that case, how can you call this as an asset? You can just expense it out in P&L. This is the doubt that I've got. But what I'm trying to tell you is that I'll give you another example. Take prepaid insurance. Yeah, prepaid insurance. You pay, say, for example, 10,000 upfront for fire insurance, for example. If there is no fire in future, you lose the insurance amount that you paid. It applies for all the insurance. But you still record it as an asset initial and then you amortize it eventually. Because you are buying a right to protection there. Just like here, you are buying a right to favorable price movement. Are you able to understand? That's why don't buy hard. That's why I'm giving you all the logical explanation over here. Got it? Lot of assets involve uncertainty, Nana. Shares, bonds, real estate. Just because there is uncertainty, just because you expect them, their price to fall later, you don't expense them, na? Because of that logic, if you start expensing out, every asset needs to be expensed out. Okay, similarly, so the fact that the option might expire worthless doesn't prevent it from being recognized as an asset today because it has a measurable fair value now. You got the point? Got it? Now, this doubt is cleared. Everybody hereafter don't buy heart. I hate buy hearting. Okay, you got the logic. Follow the logic. Asset definition also it's satisfied. It's a resource control. Ultimately, you also need to get future economic benefits out of it. We are getting it. Therefore, we recognize that as a right. Hereafter, okay, the blind thought process is this way. Right means mostly it will be an asset. Obligation means it will be a liability. That's what we have seen in financial asset definition and financial liability definition as well. Okay, moving on. So we are done with this. 31st March 2018, that is the reporting date. So what is happening? You have to do fair value. Why? Because we are following FETPL. Derivative means FETPL accounting. So FETPL accounting means what? We'll always measure it at fair value at each reporting date. And whatever the changes in fair value will be there will be taken to what? P&L account. That's what FETPL accounting means. So we are doing FETPL accounting when it comes to derivatives. Therefore, you have to do fair value measurement on 31st March 2018. Even though you keep the option with you, you haven't sold the option, you don't have intention to sell the option, you want to wait till the settlement date and then eventually you want to exercise the option. You understand what I'm trying to say? Of course, if the option is in your favor, you will exercise. So, we are applying FETPL, therefore we are doing the remeasurement. So, for fair valuation on balance sheet date, so what you have to do, even though you're not selling the option, imagine as if you have sold the option. You got the point? You have to imagine. So pseudo selling, false selling, okay, only to identify how much will be the value today. So if you sell the option, what's the value, Ray? 19 on balance sheet date. You have purchased at 12. So there is a gain, obviously 7. So if there is a gain, already you have recognized that as an asset. At how much? 12 is the value. Now asset value will get increased. And that increase in asset value will be taken to what? P&L account. Yes or what? Because this is change in fair value of the asset. Earlier the fair value of the asset was 12. Now the fair value asset is 19. So there is a change in fair value of the asset by how much? 7 rupees. That change in fair value should be taken where? P&L account. Why? Because the method that we are following is FETPL. Any change in fair value should be taken to P&L there. It's a matter, that's all. Clear? Fantastic. Now, so we have passed this entry. Next, 30th April 2018, we have come to the date. What date, Nana? Settlement date, right, Nana? Okay, so here we will take two cases. Here in this example, he just gave you one scenario where obviously you'll be exercising the option, which is 125. We'll also take another scenario where in case if the market price is 60, where you don't get to exercise the option, because we need to see both the perspectives. Now we are learning accounting. So therefore, I've considered both the alternatives. Clear? Now, case 1, when the market price is 125. Will you exercise? You means A Limited. Will it exercise the option? Yes, it will, because it has got right to buy at 90. Market price is 125. So it will exercise the option, it will buy at 90 and it will sell at 125. You understand the point? So therefore, benefit due to the call ultimately is how much? You have an exercise price at which you have right to buy, which is 90, and now your market price is 125. So therefore, there is a benefit of 35. Total benefit. In this total benefit of 35, how much did you recognize already? 7 plus 12. Got the point? Already your financial asset derivative is standing at a value of how much, Nana? 12 plus 7, which is around 19. Ultimately, you have recognized that your asset value is actually 35, but it is standing at 19. So still you will recognize the asset value in the sense for the difference, right? Which is 35 minus 19, which is how much, Nana? 16. To that extent, you will increase the asset value. Obviously, you have to debit to increase the asset value. You do that, and the difference will be taken to P&L account as usual, because we are following FETPL. Got the point? Right. That's it. Now, in case if there is a settlement by delivery of share, in that case, what you will do? So you will be making a payment of 90 rupees because you have a right to buy the share at 90 itself. Whereas you will be getting a share which is an asset, so you have to debit it, saying that the share name, whatever it is, you will debit it, and the actual worth of the share is 125. So therefore, the difference of 35, what you will do, that has to be taken to P&L account. But already I've taken to P&L account, and then I've recognized an asset in that place. Now that you have purchased the share, that derivative asset no longer exists. So therefore, cancel it out. You understand the point? Everybody, chalo. Moving on to second alternative. Second alternative is what, Nana? Where market price is 60. Obviously, you will lapse the option. A Limited will lapse the option. Once A Limited lapse the option, already you have recognized an asset to the extent of 19 rupees. This asset no longer exists, correct? Because you have lapsed the option and your value of the call is 0. Therefore, that asset needs to be cancelled out. How will you cancel it out? Reverse entry. That's all. You got the point. How will you cancel an asset? By crediting it. By how much? How much ever value it is. What is the value right now? 19. So to the extent of 19, you cancel it out. So to financial asset derivative 19. Where you will take that? P&L account only, naturally. Cancel it or kill it, whatever it is. You'll be taking to P&L account only. From where you'll get money from, obviously. You have to take it to P&L account. Got it? Done with this? Okay. Now let's do the accounting in the books of B Limited. Who is B Limited? Option seller. So option seller basically sold this option at a premium of 12 rupees, which means on day one, if I am the option seller, if I am B Limited, I'll be getting 12 rupees, correct? If I am getting 12 rupees, what will I do naturally? I'll be debiting bank account because I get money. Got the point? At the same time, this option selling creates an obligation to what? To sell a share tomorrow if the option buyer exercises his right to buy. You don't have a choice, you have an obligation. So even though you feel like today you have got 12 rupees and you have debited your bank, on the side simultaneously you have created a liability. By why liability? Because you have an obligation in future. When there is a right, treat it as an asset. When there is an obligation, treat it as a liability. As simple as that. Got it? So financial liability within brackets, not a normal financial liability, it's a derivative financial liability. That's what we have done. Clear? Okay, next, as usual, we go to reporting date, because whether it's financial asset or financial liability, it doesn't matter. We have to apply FETPL because it's a derivative. Simple and straightforward. Got it? So obviously on the reporting date, what we have to do? We need to see what's going to be the value. So on 1st February, you have sold an option at 12 rupees. Today, if you want to sell the same option, you can sell it for 19 rupees, which means you have sold it at a lesser price. You understand the point? Today, if you want to sell it, you have to sell it at 19. Now, if you want to cancel your position, you have to take opposite position. What is your position right now in this particular derivative? Short position, because you have sold it. To cancel it out, what you have to do? You need to buy it. If you want to buy it today, you have to buy it by paying 19. So therefore, there is a loss of 19 minus 12, which is 7. Correct? So when there is a loss, obviously you will be transferring to P&L account because you are following FETPL. Correct? And because there is a loss, obviously your financial liability will increase. So what will be your entry? P&L account debit, because to there you will be taking the loss, and your financial liability has to be increased. Liability increased means you have to credit it. So I've credited, it is 17. Now my liability stands at a value of 19 as of now. Financial liability derivative. On the settlement date, as usual, we have two choices, just like here. So if the market price is 125, definitely option buyer will exercise the option. If he exercises the option, then I, as an option seller, has to buy the share at 125 from the market and sell it to him at 90 rupees, because I have an obligation. So if I buy from the market at 125 and sell it to the option buyer because he exercises the option at 90 rupees, I experience a loss of how much? 35. Already I have recognized a liability of how much? 19. Still my loss has got increased to how much? 35. So this additional liability also I need to recognize now. So recognize that by debiting P&L account and increasing the financial liability. After that, if the settlement is on cash, then you will cancel out the entire financial liability, because your financial liability right now stands at, here it is 19. 12 plus 7 plus 16. Correct? Total it will be 35. Your financial liability will be standing at 35. You cancel it up, debit financial liability derivative to bank payment. That's all. You pay that 35 rupees. If it is cash settlement. If it is settlement by way of, what is that? Delivery. Then in that case, what you do, obviously, first thing is you need to buy the asset from the external market. Buy the share. How will you buy? By paying 125. So to bank, pay 125. Buy the share. And that share value is how much? 125. After that, what you have to do? You need to sell this share to somebody at 90 itself. So to investment in share, because you're selling it to somebody for 90, you will get 90 rupees. So bank account debit 90, and there is a difference of 35 rupees. That is 35 rupees loss logically should go to P&L account. But already I've transferred it to P&L account from time to time, and in that place I've created a financial liability equivalent to the loss. Therefore, to that extent, I'll debit the financial liability in the place of P&L account. Are you able to understand how the accounting works? Clear, everybody? Chalo, fantastic. That's it, Nana. So now we have covered forward example, futures example, derivatives example. I mean, sorry, not derivatives, options example, and option buying, option selling, both. And both the scenarios also we have covered, where your option gets exercised, where option does not get exercised as well. Clear? And I've clearly explained you the logic, why here it's treated as financial asset in case of option buyer, and why it is treated as financial liability in case of option seller. That's very important. Why? Because don't try to by heart. It should come naturally. Okay, right. Now let's look at the summary. This will help for you the day before the exam. Okay, right. Let's start with the forward contract, which is a derivative, obviously. So if you take a long position, which means you have agreed to buy, in future, if the spot rate is greater than the forward rate, which means forward rate is the rate at which you have agreed to buy, correct? When compared to this rate which you have agreed to buy, if the rate in the external market, which is nothing but spot rate, if it is more, definitely you will be buying at a lesser rate, that is forward rate, and you will be selling at a higher rate, obviously. So you'll be getting a gain. So whenever there is a gain when it comes to a derivative contract, it's a financial asset. Clear? Suppose if your spot is less than forward rate, obviously in that kind of a situation, you'll be getting a loss. Yes. So once you get a loss, obviously it's gonna be what, Nana? Financial liability. Probably in between anything would have happened. Say for example, if the market would have gone in your favor, then you would have created a financial asset. Then after that, suddenly market went against you. Then whatever the financial asset that you have created, you need to cancel it out, debit the P&L account, and then create a financial liability. You understand the point? Right. Let me show you. I think we have already seen this. Just now we have discussed. In case of futures, we have discussed. Futures and forwards are exactly same, Nana. Mukku fellow, you're asking me this doubt. See here. Here, what has happened? Initially, there was no entry. After that, you have recognized the financial asset now, because market went in your favor. It went to 275. You understand the point? Your position was to buy at 265. So you have created a financial asset derivative for 10 rupees, and you have taken that to P&L account because FETPL accounting. But then what has happened? All of a sudden, you faced loss. then already whatever the financial asset that you have created, you cancel it out and debit the P&L, because already you would have created it. So you cancel it off, you set it off. And then for the actual loss, you'll book a financial liability derivative. Can you see this? That's what I've written here. I hope you are able to get. Chalo. When it comes to short position in case of forward contract, it's exactly the opposite. Opposite in the sense, if a spot is less than forward, because short means selling. You have decided to sell at the forward rate. This is selling rate for you. So your spot rate has to be less than the selling rate, so that you can sell at a higher price and get the gain. And then eventually it becomes financial asset. In derivative, whenever there is a gain, it's a financial asset, Nana. Whenever there is a loss, it's a financial liability. Clear? Right. So it's exactly opposite. If spot is greater than forward, in that case, you'll get loss, and that will be a financial liability eventually. So whatever that we have seen the logic here also exactly the same thing, cut, copy, paste. Only difference is here the rate will be called as a forward rate, and it is a private over the counter contract between me and you, two different organizations. Whereas when it comes to futures, it happens in the stock market. Got the point? NSE and all those things. Yeah, BSE and stuff. You got it. The only difference is here the future price at which you have agreed upon to buy or sell depending upon your position. We call it as forward rate in this case. Here the same thing will be called as futures rate. That's all. Got it? Right. So this is exactly similar to what we have discussed over here. Right. Next, coming on to call option. If you're a holder or buyer of the call option, it means you have taken a bullish view, right? Which means you're expecting the prices to increase. So tomorrow, if your external market price is greater than the exercise price, the exercise price is the price that you have committed to buy. External market price, if it is greater than that, then you can buy it at a lesser price and you can sell it at a higher external market price, correct? In that case, you'll be having a gain, and that's a financial asset, and you'll exercise the option as well. Suppose if your external market price is less than the exercise price at which you have to buy, in that case, you will not be exercising the option over here. So there is no liability getting created. You understand the point? Because your loss is limited only to the extent of the initial premium that you have paid. You understand the point? So you'll just lapse the premium. That's all. Initially already you have paid, na? That's it. There ends the matter. Your loss is limited for you as an option buyer. Here again, you will not be creating a new financial liability. That will not happen, especially in case of option buying. Coming on to option seller, yes, he'll create a financial liability at the beginning itself. Why? He has got an obligation to sell. Here, I'll write the reason. Financial asset. Okay. Right to buy. So right to buy is a financial asset, basically. That's why option buyer recognizes financial asset at the beginning, right? Coming on to seller, he recognizes financial liability because he has got an obligation. Of course, he receives money into his bank at the beginning. Here, he pays money in case of option buyer, correct? Right. If your market price is greater than exercise price, then what happens? The other guy, the option buyer, he will exercise the option because his exercise price is less than the market price. So he will exercise the option. We are talking about call option, and then he will buy it at this lower price, which is X, and he will sell it at the higher price. Got it? If he is having gain, then we are going to face exactly same amount of loss. Because when it comes to option buying and selling, it's a zero-sum game. Zero-sum game means if the option buyer has got so much of profit, exactly equivalent loss will be there for option seller. Got it? Chalo. If market price is less than exercise price, then what will happen? The option buyer will not exercise the option because this is the price at which he has to buy, whereas market price itself is cheap. In that case, he will buy from the market only. Why will he excise the price? So he will not excise. In that case, you don't have an obligation. Then cancel your liability, which you have already created. Clear? Right. And the initial premium, whatever that you have received, that you will enjoy as an option seller. Now, coming on to put option. Now, put option exactly opposite you need to think. Why? Because put option means what, Nana? Right to sell. Here I'll write in option buyer's perspective. Right to sell. Correct? Right to sell. Okay. If you're a put option buyer, then your actual view is bearish. You want the market to go down because you have purchased right to sell. You are expecting market to go down. Therefore, you have purchased the right to sell at a higher price. You logged now itself the price. Okay. Tomorrow, if exercise price is greater than the market price, which means the right to sell is the exercise price. So your price E is greater than the market price. Then what you will do, you will exercise the option, you will sell it at a higher price, and you will buy it from a lower price from the market. You understand the point? You will enjoy the profit. So you will exercise the option. Obviously, it's a financial asset for you. For buyer, it's a financial asset now in case of options. For seller, it's a financial liability, as simple as that. Then if the price is not in your favor, in the case when compared to your exercise price, if the market price is high, if market price is here, then you will not sell at this price. Nah. Why would you sell at this price when you can sell at this price in the market? You understand the point? You will not exercise. So therefore you will lapse. That's all. It will not create any liability. In case of option, you will not see liability getting created for option buyer. Got the point? Just because he has lapsed the option. But in case of forward and future, it will get created. In case if you are facing loss in future. Got it? Because in options, you have got right. In forward and future, it is an obligation even for you as well. You understand the point? Only in case of options, one has got the right, the other has got an obligation. Therefore, the guy who has got the right will create an asset, financial asset derivative, and the one who has sold the option will will get a liability, financial liability, right? Now, put option seller point of view. So in put option, seller will be basically bullish. In put option, seller will be bullish, buyer will be bearish. Okay. Now bullish means you are expecting it to increase, because bull, that's what it does. Now the logic is very simple. Now when bull attacks, it attacks like this, from you know down to up. So therefore, whenever market goes up, they call it as a bull market. Bear means usually it slaps like this. That's how bear attacks with its paw. So because it slaps like this, eventually it shows like the market is going down. That's how they call the falling down market as bearish market. Anyways, now writer or seller. So you have sold the put option, right? So if the exercise price is greater than market price, basically what happens? Exercise price means the right to sell price. The right to sell price is greater than the market price, which means the other guy, the option buyer, will exercise the option, which means it's a loss for us because you have obligation to sell. Sorry, obligation to buy here. It's a put option. If it is call option, obligation to sell. Anyways, if exercise price is less than market price, exercise price is the right to sell price, and that is less than the market price, which means you can happily sell it in the market itself. So therefore, the other guy will not exercise the option. Therefore, we don't have any obligation. Clear? That's it. Are we done with this, everybody? Chalo, fantastic. We have seen the examples. We have also seen the accounting part. We have seen all the forward, futures, as well as options, both from buyer's point of view and seller's point of view, right? Chalo, fantastic.